You've seen the headlines: US-China truce, tariffs paused, risk is off. The market is breathing a sigh of relief, and that relief is a trap. This isn't a peace treaty, it's a one-year ceasefire. And what the media is calling a deal is just a temporary pause on a permanent economic war. The real problem is that investors want to believe the good news. We see a truce and immediately think about piling into cyclical stocks, autos, chemicals, textiles, assuming that the coast is clear. This is exactly how you get wiped out. During the last major tariff flare-up with the US, the Indian market lost $180 billion in 2 days. This Apex Summit truce hasn't solved a single core issue. Not tech supremacy, not made in China, and certainly not the Taiwan issue. So what did this landmark deal actually achieve? The US agreed to pause some tariffs for 1 year and reduce the fentanyl-related ones. In return, China agreed to pause its export controls on rare earths and buy some American soybeans. This isn't a strategic reset, it's a transactional ceasefire. They haven't solved the underlying problems, they just postponed the fight. The major underlying problems here are technological dominance and global military posture. And guess what? Analysts from the Brookings Institution have already pointed out that this is an illusion of progress and that Washington and Beijing already have different interpretations of what they even agreed to. The trap is believing this is permanent. It is, by design, temporary. Let's game this out for your portfolio. Scenario A. The truce holds. Let's say, against all evidence, this fragile peace lasts. What happens? We get a short-term relief rally. Stocks that were hammered by the trade war might jump. The market feels good for a few quarters. Scenario B. The truce breaks in a few months. This is a scenario analysts at the Chicago Council on Global Affairs believe is inevitable. The strategic competition is here to stay. A new dispute over semiconductors, a fresh move on Taiwan, or the one-year clock simply running out. And if this truce breaks, the market reaction will be sudden and violent. All those cyclical stocks bought in the relief rally would probably lead the crash. The problem is, scenario A is a sugar high. Scenario B is the inevitable heart attack. Mainstream finance is selling you scenario A. I'm telling you to prepare for scenario B. So what do you do as an investor? You insulate your portfolio from the volatility. This isn't about being bearish, it's about being anti-fragile. Here are 3 practical moves to consider. First, reevaluate cyclical stocks. Look at your exposure to those export-linked sectors that are totally dependent on global peace. You might be overexposed to geopolitical risk without even knowing it. Second, embrace the defensives. When the last tariff shock hit, figure out which sectors did well and why. Third, the domestic engine. Look for companies that get 90 to 100% of their revenue from the domestic revenue. The local consumer-focused companies. Their earnings are insulated from whatever tariffs are announced in Washington or Beijing. This is your no-regret move. If the truce holds, these sectors will still grow. If the truce breaks, they will be your shield. So let's summarize. The US-China truce is a headline, not a strategy. It's a one-year pause in a multi-decade economic war. The solution is insulation and diversification. Your action item today is simple. Don't just read the news. Read the subtext. Open your portfolio, look at every single stock you own, and ask yourself one question. How much of my money is sitting directly in the path of this fight? Your future self will thank you for it. See you tomorrow.